Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta, Executive Writer at CTMfile. Joining me today are Paul Galloway, Senior Advisor at Strategic Treasurer, and Jack Large, Editor of CTMfile. Thank you for taking the time to share your thoughts with us on topics that impact corporate treasury. Paul and Jack, I'm extremely grateful to you. It's time to get some deeper insights from you on our topics for today, namely embedded finance, bank API integration, the US dollar losing ground as dominant currency in global trade and finance, and money market funds benefiting from recent bank failures. Our audience can read these articles and also research content more deeply by visiting ctmfile.com or by following the links in our show notes. Let's get started with our discussion, Paul and Jack. Our first story for today is about embedded finance coming of age as more corporates are integrating or embedding financial services such as bank accounts or wallets, payments and lending into their product offerings to monetize their customer base, drive growth, and add new revenue streams. According to the Stripe Insights 2023 report, this year, 75% of all global businesses plan to offer embedded finance to their customers. In the light of the article and the Stripe Insights 2023 survey report, Jack, if I may ask you this question first, how do you think embedded finance will impact the corporate treasury landscape in the coming years?
This is a classic example of where, and in the Citibank report last week, where one of the things was for the functions of Treasury was to add value to the business. This is another example, a very important example. The scale of what's been happening is much greater than most people realize. Stripe is already bigger than Citibank, and it's just a payment systems company. That's all they do. That's the first point. The second point is how corporate treasurers use the different tools in embedded finance will vary considerably. What I found surprising was that the specific other embedded finance, which is turning products into services, which is what Apple have done with quite a few of their products, so they get ongoing revenue, not just a single payment, but ongoing revenues from that particular stream. This is going to happen here. Other thing that I feel is important is that we're going to see it vary by country, very much so. So, fact that it works for one company in, say, Nigeria doesn't necessarily mean it'll work for another company. It depends on the embedded streams, natural streams within the business.
What we're seeing here, and to Jack's point, in terms of companies' abilities to deploy embedded financial tools within their platforms, I think for some companies it definitely will make sense. Other companies, this is not something that is probably a good fit. The fact that this continues to grow and the opportunity that's out there, I think it's just showing that payments are becoming a bigger centerpiece for treasury functions in any organization around the world. The adoption rates of something like this is going to be dependent on the position of the company, not only in terms of what they offer, but how sophisticated they are. Some organizations just don't have the platforms that could support something like this. And so they're going to have to, upgrade if this is something that they want to do. It makes sense for their business. So I do see that what we're going to have over a period of time, and I don't know, is it you have an adoption rate that can capture 138 billion by 2026. I don't know. That's pretty aggressive growth over the next 5 years, being 3.2x. Maybe it does. Now I'm not sure where the adoption rates will go, but I do see this as being a valuable tool for many companies out there. PaaS, SaaS, now we get BaaS here as banking as a service. The proliferation of APIs. The tier 1 banks have APIs in place for the most part. Tier 2 banks are starting to follow. We're seeing fintech organizations adopting APIs. And so I think as these tools continue to proliferate to organizations that are smaller in stature, I think the opportunity for the use of a banking platform like this makes more and more sense, and we'll see more adoption.
The other important point is what we're starting to see is the disintegration of the automatic use of banks. These APIs and these embedded finance products don't necessarily have to be provided by a bank. They can be provided by third parties. This is going to take a lot of managing by treasurers, but there are massive opportunities here to change the whole profile of their company's business, as I mentioned before, as Apple is doing right now.
Those are interesting thoughts. And as embedded finance continues to be driven by APIs, our next story, which is around bank API integration, merits discussion, which is about Enterprise Technologies, a NASDAQ Ventures-backed Treasury capital markets platform, announcing that it has launched its bank API connectivity to connect corporate treasury teams with their banking relationship partners instantly. This connectivity transpires from a broadening acceptance in the banking community to adapt more API technology and replace legacy forms of bank connectivity. Corporate treasury teams are also increasingly using API technology to manage cash and payments. Paul, can you explain how bank API integration can benefit corporate treasury teams, and what kind of data and information can they access through this connectivity?
Yeah, Push, the use of the APIs and the connectivity will allow treasury teams access to information that is not as easy to get today. When you think about this article here, and it talks about bond pricing in particular, this is definitely an important aspect for treasury teams. As a treasurer, when I think about capital management, the broader scope of liquidity for the firm, and what I'm going to do to manage the weighted average cost of capital for the company, this ability to get or streamline bond pricing or get indications on bonds, I think is really valuable. I can go back to my days where I spent for a large insurance company raising capital for the firm. And I can tell you getting pricing indications was always a challenge. I had to go to market comps. I had to dig into Bloomberg. I had to call my bankers. I had to monitor this stuff on a regular basis to understand, where are the underlying benchmarks at? What do spreads look like for companies like myself? What do they look like for credit profiles similar to mine? And getting that information would help me in the conversations with banks if I was in a position where I needed to raise capital or wanted to raise capital. Anything that can streamline this process, I think, is really valuable to corporate treasurers. It's broader than just bond pricing indications for these applications. So you can think about the other tools that treasurers will utilize for information. And it could be anything from pricing indications to returns on short-term investments. It could be competitive intelligence in terms of what your competitors are doing in the markets, that you can gather information that would be valuable to know how they're trying to position themselves. And you can learn from that as a treasurer and help you manage the different work streams that you have responsibility for.
My reaction to this story is it's basically old news, but what it does show, because this is just an example of another API supplier connecting things together, it does show, though, the importance of the treasury management system in analyzing and collecting all this information. I think the emphasis on the need for real-time treasury and real-time systems that really cope with it is going to increase. I would be asking my TMS supplier, how can you cope with this? How does this fit inside your treasury system?
Yeah, Jack, when you think about the dynamics of how payments are changing, the types of payments or the acceptance of variable types of payments, and the timing of that is changing. So whether it's same-day real-time payments, 24/7 payments, stuff that can happen over the weekends, cryptocurrencies or digital currencies versus fiat currencies. I think this type of technology over time is going to be utilized more and more. And to your point, it needs to be part of your fintech platform, TMS or otherwise, in order to get the data you need to make informed decisions. So, it's not necessarily new news, to your point, Jack, but I think it's demonstrative of steps we're taking forward in this process.
Our next story revolves around the US dollar losing ground as the dominant currency in global trade and finance. While the dollar has been the world's preeminent currency in global markets, its share of global foreign exchange reserves has been falling gradually. According to the IMF's currency composition of official foreign exchange reserves data, the share of reserves held in US dollars by central banks dropped by 12 percentage points since the turn of the century, from 71% in 1999 to 59% in 2021. Jack, do you think the steady decline of the US dollar's dominance in global trade and finance will impact a multinational corporation's treasury management strategy in the near future?
I don't think it's the decline in the share of the overall market. It's still huge. It's the fact that new currency types, even group currencies like the initiative between Argentina and Brazil, are making it more complicated for treasurers to make the decisions. In some ways, I feel this doesn't matter because this is inevitable. The decline of a single currency is going to happen as you get more new payment systems, more new clearing systems that Paul was talking about. The key surprise for me is how little the euro has grown in share over the last decade. And the other thing that's surprising for me is the fact that the Japanese yen is still pretty dominant for central banks. But my overall reaction is I don't think it matters. The corporate treasurer has to sort out, because they're not involved in these decisions behind this share between the currencies. What they have to do is pick and choose which ones they think are going to be sensible and which aren't, which is what the recent banking crisis has shown. The choice by treasurers is key.
The decline or mean reversion or whatever you want to say along the way, 60% is still a massive number. It's huge. Is it going away rapidly, quickly? No. Do I think fiat currencies are going away quickly? No. Do I think digitized, tokenized currencies are going to start growing, that are going to change this landscape and make trade financing perhaps different over time? I absolutely do. So I think from a central bank perspective, the ability to get to a digital coin or a digital payment, I think is going to be really important. I still don't think that fiat currency is going away, but digital coins or digital currency is going to become more prevalent. So the ability to effectuate that for payments, I think, is going to be important. The other thing for us, thinking about US dollar as a reserve and as it declines over time, that means that, our central bankers are going to have to position ourselves as things continue to change. And the ability to create the non-fiat currency that is accepted and getting it out there in front of everybody else, I think will be important for the U.S. Just to maintain a certain level of reserve currency out there. Because I do think that digital currencies will become acceptable as a reserve. So it's an interesting dynamic. I think it's interesting, to Jack's point, there was the point of Euro came out, and they thought the US dollar was going to die. If Brazil and Argentina come up with the SUR and it becomes the currency for South America, does that change things? Well, I think it's another player. We know we got China and Russia with their trade agreement to trade in rubles and Chinese yuan, that they're trying to position themselves so that they don't have to rely on US dollars. Is that a bad thing? Not necessarily. If the dollar was to totally collapse and everybody was to say, we're not trading with US dollars anymore all at once, that would be a bad thing. That would be a hard thing to manage. But I don't see that happening. I think it's something that we'll be able to manage over time.
I'd just like to make a final point. As an English-speaking Englishman, I'm disgusted by the word de-dollarization. It's awful. It shouldn't be allowed.
Yeah, Jack, I saw that too, and I was like, why? That's an odd term. The dollar's not going away. I don't see it disappearing by any means. So that's probably, it's an inaccurate term to use, but that's the term that they're using in this article.
Well, those are interesting thoughts. I guess the lexicon in terms of de-dollarization is being bandied around, as well as you rightly mentioned, the dollar isn't really going anywhere. Our next story is about money market funds benefiting from recent bank failures, as significant deposit flows have moved into money market funds. Estimates suggest that as much as US $550 billion in deposits have moved to larger, safer banks or money market funds. Inflows to money market funds or MMFs account for an extraordinary $250 billion of the total money moves over the past 2 weeks, primarily driven by investors piling into government funds that concentrate on short maturity Treasury securities. Paul, with significant deposit outflows into MMFs, what do you see as the benefits and potential risks of using these funds for corporate treasury?
Yeah, Push, I can definitely use real live example of money market mutual funds and the use of them. They've been around for some time now. Some people will know, following regulation around these funds, there's a push to make some changes in regards to the net asset value and how that's calculated. And when we think about these funds, I worked for an insurance company. I managed a lot of cash, billions of dollars, and COVID hit and people got fearful, and we moved a lot of investments that were at maturity or near maturity into cash. We got really liquid. So we put everything into cash. And not only did we put it into cash, we put it into government market, money market mutual funds. So we started moving out prime funds. When we talk about government or treasury funds and prime funds in here, and I think what people need to understand are a few things with these funds. They need to understand, are there any gating fees associated with the funds? Because some of these funds will have gating fees. Typically, your treasury government funds don't, but your prime funds do. You also need to understand the liquidity of the fund. Some funds are going to be a little more liquid than others, so you need to understand the liquidity pool that you're buying into. When you look at prime funds are longer duration than your government treasury funds. So they have a little less liquidity and they're taking on more risk. The difference between these prime funds and these money market, these government funds, is that you're dealing with fixed NAVs and floating NAVs. They call it stable NAV. It's really a floating NAV. And one of the things we found out quite quickly when COVID hit is that the NAVs on those prime funds took a big dive. Yields took a big dive. You couldn't find any yield out there. The prime funds almost collapsed on top of the government funds in terms of yield. And we didn't see a rise until the Fed started raising rates. And so it became a lot more appealing recently to dive into these, especially when risk was perceived or seen out there with bank failures. And so going to these funds made a lot of sense to pull out of banks, off banks' balance sheets and put it into these funds as a little more secure way to invest your cash and not have the risk that a bank might fail. What we're seeing, the phenomenon makes sense, but I think people just need to understand what they're actually investing in and what that might mean in terms of the principal of the fund. If you're investing in prime funds, that principal amount will move. Your government and treasury funds, those are stable. They're fixed. The NAV's at 1. So your NAV's not moving around, but you're not getting as good a yield, but you're getting better liquidity. So there's some trade-offs to managing across funds like this. So I'm not surprised by the move to the money market mutual funds, given that the yields have come up from 1-2 basis points front end of COVID. Prime funds were like 5 to 7 basis points. Terrible yields. You can't get any yield on cash. We can get it today. We have an inverted yield curve. These short-term rates are attractive, and you get the liquidity along the way.
For me, the most important, interesting figure here was that the corporate funds, the prime funds that they offer, they are actually, and I understand the implications of when we had the pandemic, but it shows that there are increased opportunities for corporates to actually lend funds to the market through the prime funds channel. And that's one point. But the other point is that the number of complexity and balance of the decisions for the corporate treasurer, I think, is increasing, not decreasing, because we not only have the small bank issue and problem, we also have a similar sort of thing with the funds in different ways. I think the importance of the corporate treasury becomes more important as we get to this sort of phenomenon.
Yeah, I think that's absolutely right, Jack. When you think about, I think you might have been referring to the reverse repos. When you think about reverse repos, it is a lending facility. You're lending something, you're getting something in exchange for that. Reverse repos are used in prime funds. They're used for any securities lending program or any other backstop facility that a company might have with a bank. You can engage in reverse repos with banks on balance sheet. So there's various opportunities to do that. So I think to Jack's point, it's understanding what those underlying assets are that the funds are investing in, I think is really important. And you need to look at the prime funds close. You need to understand what kind of risks they are actually investing in. You might find a fund that's offering a better return, but the risk profile may not be something that's acceptable in your investment guidelines.
Yeah, to follow up on that, these decisions aren't purely AI type decisions. They're actually seat of the pants experience that makes these decisions. The corporate treasurer is not going away. I think in some ways he or she is becoming more important rather than less.
Oh, spot on.
Couldn't agree more. Finally, what is your choice for the biggest or most important story of the past week and why? Jack, if I may ask you to go first.
Oh, it has to be the first story about corporates getting into funding in all sorts of different ways. The opportunities there to change the very nature of the business that you operate in is phenomenal. I think that is the number one thing, but I would add that we need to get into changing to a subscription-based service model wherever we can.
From my perspective, one of the things that just sticks out to me is President Trump is being arraigned today. So, that story it's just incredible to think that this is where we're at right here. And, the crazy thing about this story is that nothing may come of this. Something potentially could, even if it potentially does happen, it may not preclude Donald Trump from running for president of the United States again, and he's leading in the polls. This is just bizarre and fascinating at the same time. I'm not a political junkie, but this story is just something that I can't ignore.
Well, over the pond, quite a few of us are just amazed and flabbergasted this is happening.
Oh, yeah. It's not good. It's not a good thing. And some people are cheering this on, and, I'm not somebody that is one way or the other. And I just think this is just not a good thing. It's not something I expected by any means.
An important point comes out of that, Paul, is that treasurers are going to have to take into account that the seesawing in the economy and the business conditions could dramatically change even in the run-up to the election. Unfortunately, you can't ignore this sort of thing. You have to take it into account in your investment policy and strategy.
You absolutely do. I feel just the economist in me is not feeling very rosy about where the next 12 months will be. I think there's going to be some rough weather ahead for us from an economic standpoint.
A rough weather ahead from an economic standpoint. On that note, we are going to conclude this episode of the Open Treasury podcast. But before that, I'd like to extend a big note of gratitude to Paul and Jack for their informative analysis, and would also like to thank our CTMfile audience for taking the time to join us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.